Rahul Chadha of Mirae Asset Management joins us. Let's take our conversation forward. Rahul Chadha of Mirae Asset Management is ready. Let's connect with him. Rahul, good morning. Thank you for joining us. Rahul, Indian markets are outperforming. We are staring at a market like never before. While nobody is complaining, at least nobody who's long in the market is complaining about this outperformance. My question is that do you think this outperformance is real and it is here to stay?
Okay. So I think this outperformance is a function of multiple factors. One is obviously Indian market itself is done well. That's because of the sheer construct of the market. When we had the severe COVID wave in April, May, June, the global cyclicals, which was the tech names or the commodity names, kept the market up. And then as we saw COVID recede, vaccinations pick up, we've seen some of these domestic cyclicals, the consumer discretionary names kind of, and now banks pick up the baton, etc. So I think that's because the sheer construct of the market, you don't see the pain in index when obviously domestic cyclicals go through that, and that explains good performance from a market as a whole. The outperformance factor comes from the underperformance of China. So what's happened is we've seen China underperform big time in last 3 months particularly, and that's happened because of these fears of default by Evergrande, which is kind of a straight orchestrated default. Some of the issues which happened with the internet companies which they wanted to regulate and control, etc. So that's why if you see compared to the EM benchmark or compared to China, the outperformance would be as high as 30-35%.
We saw this kind of an outperformance in 2014 when Prime Minister Modi got elected for the first term. That changed the India narrative. Another example which I could think of is 2007 when we famously used the word decoupling. Uh, is India in general getting re-rated because of some of the factors you mentioned?
Okay, so for us to understand this better, let's understand the situation in last whatever 7-8 years. What happened was last 7-8 years, most countries have suffered from underinvestment, whereas China is kind of an overinvested. And there was a lot of promise when we had Prime Minister Modi in 2014. But look, what we saw for the subsequent years was some of the cleansing which happens as most of the banks were saddled with high NPAs, and then was demonetization, and then was GST. So the economy never really picked off. And what you're seeing now is a pent-up demand which is coming. And it's like all things are falling in place. You've got a robust demand for IT services. Wage hikes are fairly high, and that creates its own virtuous cycle. We've seen the PLI scheme kind of work wonders for the country. I mean, to give you data points, last year, despite such severe COVID, which impacted travel into the country and which literally kept the country shut for nearly 2 or 3 months. India got nearly 65 billion dollars of FDI flows. So I think there are a lot of good things happening in the background, and what happens with markets is when it gets played out in stock prices, it's almost all at once, and that is where the gains look a bit on the higher side or exacerbated. But I think what we've always kind of told our investors is that you have to play the economic cycle. And at the beginning of the economic cycle, first 1 or 2 years, valuations may look expensive. But the hope here is that, look, your operating leverage plays out. This whole story of corporate profits to GDP, which are currently 2.5, 3%, would go to 4.5, 5%. Nobody is expecting them to go back to the heydays of 7%. But as that kind of plays out, obviously, you will make money in the market. Along the way, definitely you'll get bumps. I believe you guys were talking about stagflation. So I think that becomes a near-term concern as commodity prices move up.
So Rahul, nobody can predict what's happening next. But we can certainly prepare for a downside or more volatility. So what are you doing? Are you reducing your exposure in certain sectors? Are you buying puts? How are you preparing your portfolio so that you're able to protect returns and benefit it from the volatility?
Okay, so let's look at parts of market which are priced for near perfection and which can get negatively impacted with higher commodity prices. I think consumer discretionary would be one sector, particularly the durables space, etc., where stocks have done really well. and would get impacted by the pressure on gross margins, etc. Overall demand may be a bit subdued if we see crude oil price go to 90, 95. I think a bigger concern which may come for the country is the trade deficits number. What we saw for September was an exceptionally high trade deficit number. If that number continues for next 3-6 months, then currency may come under pressure. So I think that the way over there is obviously buy some puts, etc. But then again, what we are telling our investors is that look, you've got to take a medium term view of this whole thing. And if you have a 3-5 year time horizon, one would take these dips which are going to happen over next 3 to 4 months because of higher commodity prices to increase exposure. Because from our side, when we look at the medium term story, it's been the best in last kind of 10 years. And why I say that is you've got a government which is very progressive, which is very business oriented, which is doing all the right things to kickstart the investment cycle. You have a huge pent up demand. You don't have any misallocation of the previous cycle. The last business cycle we had was between 2009 to 2012, which itself was a mini cycle. So there is 8 years of kind of a pent up demand, which is going to come through in demand for your real estate, in demand for your whatever automobiles, durables, etc. So that's where I won't be too bearish on this. But like the way I said, along the way you'll get these bumps because globally people are worried about a stagflationary hit, which may kind of come to the markets from next 3-6 months perspective as demand kind of holds back, and these supply bottlenecks cause higher prices basically.
Sure. So Rahul, curious to know in the last 3 months if you've added position or sold something in your portfolio, or at least taken chips off the table and profit taken.
Okay. So last 3 months, what we've done is some of the IT names which had a good run, got a bit expensive, took some money off the table over there, added to corporate banks. If you look at corporate banks, they've severely lagged this market. Basically, they call it the fear of fintech or the impact from the second COVID wave. These names offer deep value in a market which is kind of a fairly valued or borders at expensive kind of lines also. So we've added to corporate banks. There've been some interesting IPOs. Obviously, we've discussed these IPOs in the past also. So one is watchful of where one is investing in. You like companies with huge TAM, the ability to execute, and no strong competition. Companies having the right to win. So I think that's where we've looked at some of these IPOs in food delivery space, in some of the auto component space, which are a good play on the booming EV sectors. So I think selectively looking at some IPOs and seeing the parts of the portfolios which are a bit expensive and do not have that pricing power, may get negatively impacted by higher raw material prices. So taking some money off the table there.
Right. You know, Rahul, Nikunj's favorite question nowadays is, will the Sensex hit 1 lakh anytime soon or not? And we were chatting with Samir Arora the other day. He says surely it can hit in the next 3 to 4 years. Ramdev Agarwal from Motilal Oswal, on the other hand, said that we can hit 2 lakh on the Sensex in about a decade's time. I wanted to understand, where is it that you are, or rather, where or how far do you see the 1 lakh target in the Sensex?
Right. So we've never really looked at the numbers. See, what matters is the underlying, because numbers are a result of the underlying. So as we talk today, I think the underlying looks fairly robust. So when we look at the internet companies or the tech companies here for India, the software services company, the demand is resilient. So these names would be close to 18% of MSCI India, the key benchmark we look at. They can easily compound at 10-15%. I think banks give you higher compounding, at least 20-25%, because there's a multiple re-rating which can happen. So between these two and plus Reliance, you can look at clearly up to 60-70% of the benchmark. So I think that should easily compound at least 15% for next 3 years. And then you can put your index targets to it.
Well, thank God, Rahul, you didn't say that. Samir said 1 lakh, Ramdev was saying 2 lakh. I thought you'll settle somewhere in between, and you would say yes, in next couple of years we would touch 1,50,000.
You know, I tried, Nikunj, on your behalf to get a number out of Rahul, but he just wouldn't spell it out. Maybe you should give it a shot.
Rahul, now index could expand because of P multiple and because of earnings. Assuming that the last couple of years, we've still, the returns have been in line with what the moderate average returns are. Do you think in next couple of years we could overshoot before we normalize? Because that's how markets would move. They would overshoot in the bull market on the upside. They would undershoot, overshoot. They would overshoot on the downside in a bear market.
I think that's a great point, Nikunj. And look, we cannot really have that as a base scenario. That's kind of a bonus which plays out, but invariably that's how markets work. So if the view is that look, globally the policymakers realize that deflation is a bigger concern and not inflation, and as we saw Christine Lagarde talk about it, as we've seen Fed talk about it, that guy that look, all this inflation is supply side led, it's transitory, etc. And they're likely to kind of err on the side of caution in terms of being dovish for longer. What happens is then we have huge capital flows, then we have huge normal GDP growth, and that's where India kind of benefits. And should that situation happen, you would see an overshoot. But like the way I said before, your base case cannot be an overshoot. Your base case has to be earnings growth and historical or slightly higher than historical multiples. And if the story plays out well, then the overshoot would be a bonus.
Rahul, well, nobody is debating whether the earnings recovery is real or not. I guess there is a consensus view that earnings recovery is real and we are in a growth cycle. But it is just trying, it is about assumptions that what the earnings growth could be. So when you say that a lot of good news in consumer durable and consumer staple is in the price, what is your benchmark to understand that?
Okay. So I think what happens here is, look, these companies, particularly for staples, they are at 6, 7, 8 years record high margins. And now, if you're a business owner or senior manager, you would not like to increase margins further because you don't want to give inroads to a new competitor or other existing competitors to gain market share. So what happens is, in this period of high gross margin pressure, obviously there would be kind of an impact on their operating margins. They may trend down by a percentage or 2 percentage points. You get revenue growth, but your operating profit growth would be very subdued. So unlike in the past where the compounding for some of these consumer staples particularly was close to 15% for operating profits, I think that number may be a high single digit number. And with other parts of the market offering better growth opportunities, and that's where these names may go through some multiple derating also and lower growth rates. And I think that's what plays out, and that's where these names may do well when the globally the markets are falling or when the mood's very pessimistic. But in a normal economic uptick, these names would be underperformance.
Right, okay. Just looking at the market screen as well, we are holding on to just about absolutely a flat move, but that's okay. At 70,850, the headline number, I don't think the market should give you any reason to complain. In the meantime, Rahul, just wanted to understand how excited are you about the primary market issuances, and a long list of those actually. We've already seen how the markets lapped up Zomato, you've got a Nykaa, Policy Bazaar, Paytm, and a clutch of others in the offing.
Yeah. So some of these are very interesting companies. So one is spending a lot of time understanding these companies. And the best part about IPOs is you get phenomenal management access. You can do a lot of research at that point of time. One may not be comfortable with subscribing to all these IPOs because look, some of the recent ones are kind of a price for perfection, or they execute flawless execution, or they kind of discount flawless execution for these names over the next 3-5 years. So probably one may participate with kind of an marginal exposure through IPOs and watch these names over the next 6-9 months and then increase exposure. But look, what happens is when you have good, interesting companies which get listed, it just attracts new set of investors basically. So it gets the excitement in the market. It just expands the investment universe for overall pool of investors basically.
Rahul, you've highlighted your views on IT, but just wanted to understand whether or not one needs to look at IT from a valuation perspective. Because if you were to go by valuation, most of these stocks are at an all-time high. Uh, Given how strong the story for IT continues to be, and this is not a 1 day, 2 day story, I mean, I would believe that this is a decadal long story that Indian IT has ahead of us. In fact, not just Indian IT, I would say Indian IT tech plus digital is going to see a big boon going forward. Would you say that, for most of these companies, given how roaring the markets are, given the valuations that most of these stocks are looking at, perhaps valuation for an investor may not be the right parameter, um, to kind of ascertain whether or not to look at these companies or buy into them or whatever have you?
Okay. So when we look at these companies, look, between 90s, whatever, mid 90s to 2010, these companies traded at much higher valuations because the growth rates were much higher. And if we see the sector from 2010 to nearly 2018-19, because the core business was getting commoditized, they were facing huge amount of price pressures. Obviously, valuations also contracted to anywhere between 15 to 20 to 23 times. Now, like the way you said, with digitization becoming the key thing, and almost all companies in the world are wanting to have an omnichannel strategy. We're seeing huge digital spends coming the way of these companies. And as the revenue growth rates pick up, obviously valuation multiples are also going to expand until, again, the size becomes an issue. See, at current levels, some of these companies have defied that concerns one had on size limiting their growth. But look, 3-4 years from now, when the size become bigger and a lot of this digitization efforts are behind us, again there would be a question on valuations. But I think things look okay from 3 to 4 years perspective.
Okay, Rahul, that's all the time we have for you today. Thanks so much for joining us on today's edition of The Market.